I took $10,000 and bought NVDY, a high-yield ETF that pays massive dividends. Over 2 years, I collected $15,122 in dividend payments. Then, I did the same thing with NVIDIA stock, but every single month, I sold just enough shares to match NVDY's exact dividend payment. Same income, same $15,122 withdrawn. The NVDY portfolio, worth $22,835. The NVIDIA portfolio, where I, quote, ate into my principal every month, worth $33,745. That's an almost $11,000 difference, and NVDY was supposed to be the high yield option. In my last video, I showed you why I'm dumping all of my high-yield ETFs. I built a tool that analyzed these funds, and what I found was shocking. Yes, these ETFs experience NAV erosion. Their share prices decline over time. But when you add in the dividends, the total return is still positive. So the dividend defenders were right about that. But here's what they missed. When you compare these high-yield ETFs to simply holding the underlying asset, the ETFs get absolutely destroyed. QYLD versus QQQ, you're leaving 24 percentage points on the table. TSLY versus Tesla, you're missing out on nearly 80% of the gains. And the comments came flooding in. But that's not a fair comparison. I need the income. I can't just hold growth stocks. I need cash flow every month. Fair enough. So I ran an experiment. What if you bought the underlying stock and just sold a few shares each month to create your own dividend? You're getting the same income stream. You're withdrawing the same amount of cash. But which strategy actually leaves you wealthier? Here's how I set it up. I took $10,000 and split it into 2 strategies. Strategy 1, buy the high-yield ETF and collect the dividends. Strategy 2, buy the underlying asset and every single month sell just enough shares to match the exact dividend payment from the ETF. Same starting capital, same income withdrawn. Then I compared the total portfolio value at the end. That's your remaining holdings plus all the cash you collected. And what I found is going to blow your mind. Let's start with what should be the best case scenario for these high-yield ETFs. This is QDTE versus QQQ. On a side note, many of these ETFs are quite new, so we don't have a lot of history to look at, which says something in itself. In my opinion, a lot of people are going to have a rude awakening in the future when the current multi-year bull trend market reverses, which is inevitable if history is any guide. That's the subject of a future video, however. QDTE is a fund that uses a 0 days to expiration option strategy on the NASDAQ 100. Over a 19-month period, QDTE paid out $4,815 in dividends. So with the QQQ strategy, I sold shares every month to collect the same $4,815. At the end, the QDTE portfolio was worth $12,445. The QQQ portfolio, where I was selling shares every month, $12,611. That's a $166 difference. QQQ wins by a little bit. This is the closest result I found in all of my simulations, however. And even here, just holding QQQ and selling your own shares beats the high-yield ETF. Now let's look at XDTE versus SPY. Same concept, but this one trades the S&P 500. Over 19 months, both strategies withdrew $3,854. XDTE ended up at $12,203. SPY ended at $12,401. That is a $199 difference. QQQY versus QQQ. This one runs for 21 months. Both withdrew $2,459 in income. QQQI, $13,508. QQQ, $13,804. A $296 difference. Notice a pattern there? Even in the best case scenario for these ETFs, where the gap is smallest, you're still losing money compared to just owning the underlying and selling shares yourself. Now the gap starts to widen. AMZY versus Amazon. This is a 24-month simulation. Both strategies withdrew $7,688. AMZY ended at $14,463. Amazon ended at $15,193. You lose $730 by using the ETF. SPYI versus SPY, also 24 months. Both withdrew $2,554. SPYI ending value, $14,100. SPY, $15,619. That's a $1,519 difference. We're now talking about real money. YBIT versus IBIT. These are Bitcoin ETFs. 18-month period. Both withdrew $6,143. YBIT ended at $10,544. IBIT ended at $14,109. The gap is now $3,565. And here's where it gets serious. GDXY versus GDX, gold miners, 17 months. Both withdrew $5,100. GDXY, $13,769. GDX, $17,810. You lose $4,041. TSLY versus Tesla. This is the one I talked about in my first video. 24-month period. Both strategies withdrew $8,065 in income. TSLY ended at $11,936. Tesla ended at $16,531. That's a $4,596 difference. IWMY versus IWM, small cap stocks, 24 months. Both withdrew $5,025. IWMY ended at $8,677. IWM ended at $14,191. The difference, $5,514. Over half of your potential wealth just gone. QQQY versus QQQ, another 24-month simulation. Both withdrew $4,711. QQQY, $9,315. QQQ, $16,155. You lose $6,840 by using the high yield ETF. Now for the final two. These results are devastating. MSTY versus MicroStrategy. This one runs for 20 months. Both strategies withdrew $20,526. Yes, over $20,000 in income from a $10,000 investment. That's the allure of these ultra high yield ETFs. MSTY ended at $26,285. MicroStrategy ended at $34,413. The difference is $8,128. And finally, the one I opened with, NVDY versus NVDA, 24 months. Both strategies withdrew $15,122 in income. NVDY ended at $22,836. NVIDIA ended at $33,745. The difference is $10,900. Think about that for a second. On a $10,000 investment, you ended up with over $10,000 more by selling your own shares every month than by collecting the, quote, passive dividend from the ETF, even though you were eating into your principal the entire time. Now, I know what you're thinking. I can already hear the objections in my head. But you're depleting your shares. You're selling your investment. Yes, I am. But here's the thing. Who cares? Look at the total account value. In every single simulation, the strategy of selling shares ended up with more total wealth, more shares remaining, more cash collected, or both. The ETF share price collapse caused a larger overall wealth erosion than selling shares of your underlying holdings did. With NVDY, yes, I sold 141 shares of NVIDIA over 2 years. But NVDY's price fell from $20.48 to $15.80, a 23% decline. The value destruction from the ETF's covered call strategy was worse than the value reduction from selling shares. But the ETF does it automatically. It's convenient. Sure, it's convenient, but you're paying a massive convenience fee for that automation. The cost ranges from $166 in the best case to $10,909 in the worst case, on a $10,000 investment. How much is set and forget worth it to you? Is it worth losing 1.6% to 109% of your initial investment? What about taxes? This one is actually interesting. When you sell shares, you pay capital gains taxes. When you collect dividends, you pay dividend taxes. In many cases, long-term capital gains are taxed at the same rate or even more favorably than qualified dividends. And if you're in a tax-advantaged account like an IRA, it simply doesn't matter at all. Could there be an edge case where the dividend strategy is more tax efficient? Maybe. But even if it is, the wealth gap we're seeing here is so massive that a small tax advantage doesn't come close to making up for it. Here's the complete picture. These are all 12 simulations I ran, sorted from smallest to largest wealth destruction. Not a single high-yield ETF won. Not one. The best case scenario, you lose $166. The worst case, you lose nearly $11,000. And remember, this is on a $10,000 investment over roughly 2 years. Scale that up to a $100,000 portfolio and you're looking at wealth destruction in the range of $1,660 to $109,000. Every single time, in every single simulation, with every single underlying asset, tech stocks, Bitcoin, gold miners, small caps, the result was the same. Just holding the underlying and selling shares yourself beats the high-yield ETF. This result is not surprising, by the way. Covered call strategies, by their very nature, are going to underperform simply buying and holding the underlying asset. The subject has been even studied academically. I'm going to drop a link to this research paper in the description in case you're interested in diving deeper. So that $100,000 in projected income that I showed you in part 1, the income that E-Trade estimated I'd collect over the next year, I'm walking away from it. All of it. Because these simulations prove that collecting those dividends costs me wealth. High-yield ETFs aren't generating income. They're just selling your investment for you, badly, and charging you for the privilege. The covered call strategies these funds use cap your upside to generate income. But as we've seen, you can generate the same income yourself by just selling shares. And when you do, you keep all of the upside. You participate fully in the gains, and you end up significantly wealthier. The income isn't free. It never was. The question was always, what's the most efficient way to generate that income? And the answer is clear. Buy the underlying, sell shares when you need income. It's that simple. If this analysis helped you avoid a costly mistake, please subscribe and hit that notification bell. It really helps the channel grow and lets me know you want more data-driven investment content like this. These videos take time to research and produce, and your subscription tells me this work is valuable. And if you found this valuable, drop a like. It helps other investors find this information in YouTube's algorithm. But there's something even worse I haven't told you about yet. These ETFs have a hidden risk that could wipe out years of dividend payments in a single day, and almost nobody talks about it. In the next video, I'm going to show you what happens to these funds during market crashes and why the covered call strategy that generates those dividends could destroy your portfolio when you need it most. Because here's the thing, these simulations were run during a mostly bull market period. What happens when the market crashes? What happens to these high-yield ETFs when you actually need your portfolio to protect you? The answer is going to shock you. Make sure you're subscribed so you don't miss it.